standards. What is as per the accounting standards 2, that is Indian accounting standard 2, valued at the lower of cost or net realizable value. In the sense, lower of cost. When I go and sell the product, for example, watch, if I want to sell in the market, the market value will be 100, and whereas the cost which I have invested to buy the same watch was 75 rupees. So I will take at the time of valuation 75 rupees, but not realizable value, because lower of the either two, that is 75 rupees or 100 rupees. So I will take as a 75, as a accounting, as per accounting standards, 75 is the true value. That is the valuation of the stock. Next, financial compliance. What is a financial compliance? Crucial for accurate financial reporting and computation of tax liability. The valuation helps in the computation of tax liability of the stock. This stock will have an impact in P&L account. That is a profit and loss account impact. Let us see what it is going to impact, how it is going to impact. Directly influences the calculation of the stock of a company, and it will affect the P&L account statement. In the sense, if we undervalue the stock and put it in the P&L account, my profit also will get affected. If I overvalue the stock and taken into the P&L account, it will definitely affect my profit or loss account statement. Coming to the methods of stock valuation, let us see how we are going to value the stock exactly and what are the methods. Number one is FIFO method, that is a first in, first out method. For example, a company has purchased the stock on 1st April 2025. The value of the stock is 100 rupees each unit into 100, that comes to 10,000. Following day, that is 5th of April, he has purchased again same material at 120 rupees into 100, that comes to 6,000, 60,000. So he will take first in, first out method. That is, first he has purchased on 1st April. So he will take the unit price 100 rupees as a base, and he will calculate the whatever stock available as on the calculation date. That value is called FIFO method, first in, first out method. Whichever first he takes purchases, he will issue the same to the production people. Thereafter, he will calculate what is the cost of the material. Coming to the second method is LIFO method, last in, first out method. This is the other way of the FIFO method. That is, 1st April, we have purchased 100 quantity into 100 rupees each, but second one later we have purchased on 5th April 120 rupees each into 100. So now here he takes 120 rupees into whatever the available stock and which is issued to the production. He will value 120 rupees as a base. That is a last in, first out method. This is a method which he uses. Next, suppose company wanted to adopt other method, that is a weighted average method. He will take, for example, first in, first out method, 100 quantity we have, and LIFO method we have 120 quantity. Both put together is 220 quantity divided by 2, because 1 plus 1, 2 divided by 2, like that. So here 100 plus 120 divided by 2, because there are 2 units. So it comes around 110 rupees is the cost to value the stock. This method is called weighted average method. Next, specific identification method. We will see the other method is called specific identification method. Here we talk about the valuation on the basis of high value or low value. This method is called unique identification method. So here he will take a high value items only, whereas low cost material also will be tracked, but you want to use higher value items only. There he will adopt this method. Coming to the last, market value versus cost. Here, the value of this valuation of a stock or inventory is valued at the lower of its historical cost or its current market value. In the sense, here, market value in the sense, if you go and sell the product in the market and where you'll get the amount is called realizable value. So, market value versus cost value, that is historical value, which we have already noted in the stores. That value is called historical value. But when you take the same material and go into the market, sell it for it, where you'll get the money, that money is called a realizable or market value. That value he will take as a base and calculate the stock. There he will arrive a net market realizable stock value. So this method is called a market value versus cost method. Now coming to the reporting, how the stock is reported and inventory records are maintained. Maintaining accurate inventory records in fundamental for effective stock management. This involves number one, stock registers and ledgers, detailed logs of all inventory movements. In the sense, we have at least, for example, 260 items where you will maintain each ledger sheet for each item. That means 260 ledger sheets have to be maintained to have a accurate and perfect data. Coming to the physical verification reporting. Physical verification in the sense, physically we will verify. Means we will see the stock with our naked eyes and then we will confirm the actual stocks against the records. Whether the available stocks are mm, matching with the records which they are maintaining or not is physical verification reporting. We will take a physical value or physical stocks available in the stores. Coming to the reconciliation, aligning physical counts with book balances to identify discrepancies, anything. For example, after verification, physical verification versus the records, if we found any kind of irregularities or errors or omissions or undervaluation or issues or purchases are not noted down in the records, will be reconciled. So this is called reconciliation of stock records versus physical verification of the material. Coming to the last, that is inventory systems. Implementing perpetual, that is permanent or continuous or periodical, intermittent inventory methods. These inventory systems are implemented in line with the standards of the company, because the company will have SOP, that is standard operating procedure, where it will maintain its records and perform all the policies, principles, rules, and regulations as per the SOP, that is systematic operating procedure or standard operating procedure. Coming to the types of stock reporting, there are four types of stock reporting. One is financial reporting, two management reporting, three statutory reporting, four frequency reporting. Number one is financial reporting. Financial reporting, which is essential for balance sheet preparation and overall financial statements. This valuation helps not only to the company balance sheet, but also to the shareholders or profit or loss statements, which they have to maintain on yearly basis or monthly or periodical method basis. So this will help a lot stock valuation and financial reporting. Next, coming to the management reporting. This, what is management reporting? The same report will be reported to the management of the company about the stocks available physically, and data which has been maintained in the books or records, internal reports for strategic decision making, and operational controls. This will help management reporting. Coming to the statutory reporting. What is statutory reporting? Statutory in the sense we have to comply with the rules and regulations as fixed by the government bodies. So complaints reports for tax authorities, including GST calculations. This reporting helps not only in the calculation for tax authorities in the sense income tax departments or GST authorities. So when we take the stock, we will take excluding GST. In the certain areas, we take including GST. So this helps to comply with the statutory reporting. Coming to the last, frequency. What will be the frequency of the types of stock reporting? It is generated on a monthly basis, quarterly basis, and annual to track performance over time. Whenever the company has would have taken the loans from the banks or financial institutions, etc., it will help to report the same of this above mentioned institutions, financial banks, whatever it may be. Because periodically bankers will come site visit and they will inspect physically the production place, stores place, inventory place, and also head office where they are maintaining the records. So they will ensure the data given to the bank on monthly, quarterly, or half yearly or yearly. They will match the data or figure out if there is any irregularities, errors, etc., undervaluation or overvaluation before going ahead to release the further funds or to have a better control on the loans given by adopting holding on operations method by the banks. Conclusion and key takeaways. There are four. Number one is boosting profitability. This helps in boosting the profitability because this helps when we maintain accurate and correct data of stock valuation, which will improve or directly enhances a company's bottom line, so that it will help the company to have a better production, better financial planning, and good relation with the banks, institution, and shareholders, stakeholders everywhere. Number two, improve tracking. This helps robust inventory control systems lead to better oversight and reduced losses. This will help to reduce our losses drastically from previous track records. Number three is accurate valuation, crucial for precise financial reporting and reliable decision making. When the stock valuation is done properly, stock records are maintained properly, and the data available is accurate, it will definitely help the company in valuation during the crucial financial position or time. Leverage of the technology. Let us see what is leverage. ERP method, RFID, and other tools streamlining reporting and operational efficiency. ERP in the sense which is become most and must for all industries, manufacturing, non-manufacturing, business, etc. to maintain this ERP, RFID, and other tools where it will bring exact reporting and improves the operational efficiency. In the sense, it will increase its profit. Thank you, madam. Thank you to everybody.